Right now, around 2.3 million Australians own at least one investment property, according to the latest RBA analysis published in May 2026. But here's the thing most people never talk about. The gap between the landlord collecting $400 a week on a single unit in Brisbane and the landlord sitting on a $10 million portfolio of 12 properties across 3 states is not just money. It's a completely different life, different problems, different tax strategies, different levels of freedom. And today I'm going to walk you through every single level so you can see exactly where you are right now and what it actually takes to move up. Let's start at level 1, the accidental landlord. This is the most common starting point in Australia. You bought a place to live in, maybe a 2-bedroom unit in Melbourne for $550,000 back in 2021. Life changed. You got a new job, moved cities, or moved in with a partner. Instead of selling, you kept it and rented it out. Now you're collecting around $590 a week, paying a property manager 7% of that, covering strata of about $4,000 a year, landlord insurance at maybe $1,500, and your mortgage is still chewing through most of the rent. After every expense, you might be $50 to $100 a week out of pocket. You're negatively geared, which means you're making a loss on paper, and that loss reduces your taxable income. For someone on $95,000 a year, that could mean an extra $2,000 to $3,000 back at tax time. But here's a massive update for 2026 that every investor needs to know. The federal budget announced in May 2026 that negative gearing on established residential properties purchased after 7:30 p.m. on the 12th of May 2026 will be abolished from the 1st of July 2027. If you already own the property, you're grandfathered under the old rules. But any new investor buying an established home won't be able to offset rental losses against their salary anymore, only against other rental income or future capital gains. Eligible new builds are exempt, so investors are already pivoting hard toward newly constructed properties. Level 2, the intentional investor. This is where things start to shift. You've done the sums. You've seen what happened with your first property. Maybe it's gone up $150,000 in 4 years. You realize the equity sitting in that place can be used as a deposit on property number 2. So you go to the bank, pull out 80% of the increased value, and buy a $680,000 house in Adelaide, or a $500,000 townhouse in regional Queensland. Now you've got 2 properties, rent coming in from both, expenses on both, but the total picture starts to change because you're thinking about yield. That Adelaide house might be pulling around 3.7 to 4% gross yield based on 2026 capital city yields. A regional Queensland property could still push 5 or 6% depending on the area, since Brisbane sits at roughly 3.5% for houses, and regional yields typically run higher. You start learning about depreciation schedules, how a quantity surveyor can find $8,000 to $12,000 a year in paper deductions on a newer build. And this is exactly why the shift toward new builds matters more now than ever, because the 2027 negative gearing rule change carves out new construction as an exemption. You're still probably negatively geared overall, but the gap is closing. Your tax return is more complex. You've got a spreadsheet now. You've set up a separate bank account just for rental income. Level 3, the portfolio builder. This is where it gets serious. You own 3 to 5 properties. You've learned how to structure loans properly, using standalone securities instead of cross-collateralization so one bad deal doesn't put everything at risk. At this level, you start thinking about cash flow differently. You've probably got a mix, 1 or 2 negatively geared properties in growth areas like Sydney or Brisbane, and 1 or 2 positively geared properties in regional areas with yields above 6% covering the shortfall. Your total portfolio might be worth $3 million to $4 million. Rental income across all properties could be $2,500 to $3,000 a week gross. But your holding costs, mortgages, insurance, rates, maintenance, and management fees eat a big chunk of that. Australia now has 6 capital cities with a median house price above $1 million, and the national median dwelling value sits around $937,000 as of mid-2026. That means even a modest portfolio carries serious debt. At level 3, you're probably working with a mortgage broker who specializes in investors, and you've got an accountant who understands property. You might be looking at setting up a trust or a company structure to manage tax and protect assets. Around 10% of property investors in Australia now own 3 or more properties, up from about 5% a decade ago, according to the RBA's May 2026 bulletin. Most people stop at 1 or 2. The lending gets harder. Banks look at your serviceability differently when you've got 3 mortgages. You need higher income, lower personal debt, and strong rental appraisals to keep going. Level 4. The Professional Landlord. You own 6 to 10 properties. Less than 1% of Australian investors ever get here. At this level, property is no longer a side investment. It's the core engine of your wealth. Your portfolio might be worth $6 million to $10 million. You're earning $5,000 to $8,000 a week in gross rent. After all expenses, you might be netting $1,500 to $2,500 a week in actual cash flow, depending on how much equity you've built and how many properties are fully or partially paid off. You've probably refinanced multiple times. You know how to use offset accounts strategically. You might have a self-managed super fund holding 1 or 2 of the properties. Land tax is now a real consideration. In New South Wales, the general threshold is $1,075,000 in combined land value before you start paying land tax. In Victoria, the threshold is far lower, just $50,000, or only $25,000 if the property is held in a trust. You're paying $10,000 to $30,000 a year just in land tax. At this level, you're thinking about which state to buy in next purely based on tax efficiency and yield. You diversify geographically on purpose. Perth remains one of the stronger yielding capitals for houses. Brisbane sits around 3.5%, Adelaide around 3.7%, and the national average gross rental yield is 4.69% based on the first quarter of 2026 data. You're matching properties to your strategy like pieces on a chessboard. Your property manager knows you by name. Your broker has your financials on file. You're not checking rental listings anymore. You're reviewing entire market reports. Level 5. The Property Mogul. You own more than 10 properties. A very small group of Australians, around 0.07% of the population, collectively own about 25% of all investment properties, and the majority of them are aged over 50. At this level, you likely have a dedicated accountant, a solicitor, a buyer's agent, and possibly a full-time property manager on retainer. Your portfolio could be worth $15 million or more. You're thinking about development, subdivisions, dual occupancies, building granny flats on existing blocks for an extra $350 to $450 a week in rent per property. You might be borrowing through commercial lending channels instead of standard residential loans. You've probably restructured ownership across multiple entities, trusts, companies, and SMSFs to manage tax, liability, and estate planning. And with the 2027 negative gearing changes on the horizon, investors at this level are already restructuring, leaning harder into new builds, commercial property, and build-to-rent developments, which remain exempt from the new rules. But here's what no one tells you about this level. The admin is relentless. Insurance claims, council compliance, tenant disputes, maintenance across a dozen properties, plumbing in Perth, roofing in Rockhampton, a vacancy in Adelaide right before Christmas. The wealth is real, but it's not passive, not at this level. You either build a team or you burn out. If this helped you see where you stand and where you could go, do me a favor and hit the like button, subscribe to the channel, and turn on notifications so you don't miss the next one. I'll see you there.